It is April the 28th, and I am doing this from the Hilton in Omaha, Nebraska. And we just have a couple of days until Berkshire Hathaway, and I'm super excited. But at the same time, wow, earnings season, so much going on. Oh my gosh. Okay, I'm going to share my screen. Couple of announcements that I always have to do. Past performance, it's not indicative of future returns. And want to shout out always to Gurula. We're having our conference on the 15th of May. So coming up really, really fast. And my colleague Richard, who does his morning show at like 9, just before 9:30. So you can get set up with the technicals. Please check him out as well. You can find all that on Gurula.net. So really, really awesome, and want to encourage that for sure. Let's see. If you're watching this on YouTube, like, share, comment. I always love that. Definitely subscribe. That's always helpful. And now, today, we're going to talk about economic news because GDP came out so funky. And then we're going to talk about earnings for the last couple of days since I didn't get to do a show yesterday since I was in transit. And what I could definitely say is there are a lot of people on these airplanes that I'm not even going to pretend that was insane. But let's get into what we are seeing on the economic side. Today it was all about this crazy GDP number that came out. And I got to tell you, even though it came out down a bit, oh my gosh, where did my comments go? Yeah, here we go. Even though it came down 1.4%. And I think that's why the market was really confused this morning when it first opened. The issue is that this is an advanced number, so there's still the possibility that there is an adjustment to be made to that, but 1.4 usually means that we were down on the month. Now, I want to really highlight, given what I'm hearing in the various companies they're reporting, I think that it's going to still extend the volatility through the summer quite a bit. Because where I think this is coming from is the fact that we have still a lot of unknowns. Okay, first of all, outside of the United States, they are not doing as well. Unambiguously at this point, too many companies have reported, but the manner in which they're not doing well, you'd really have to be psychic to be able to figure it out. As far as Europe goes, their consumers are still fairly strong on the balance sheet, surprisingly. I mean, the US consumer is very, very strong. And you can see that clear as day. I'll have some slides for next week, maybe even tomorrow. But the credit card companies that have international exposure, they are showing strong consumers across the board, with the US consumer being stronger. And Discover, which came out today, Discover Financial, which represents the lower end, right? If you were at a university, there's no possible way Discover Financial didn't try to give you a credit card, so that's who they hit. And also Discover does have the student loan business, and the loans are being paid back. Charge-offs are not nearly as high as what people would have anticipated, even in this last quarter where you no longer have some of the government stimulus. And they're like, look, here's the thing. People have jobs. It's very clear from the economic data that we're not going to have a problem with that for at least 6 months, a year. Everything is uncertain. Like, they're not trying to make bold statements, but at least as far as reserves go, because the low end of the card companies were reserving as high as like 16, 17%. Like the only other companies that were reserving like that were the broker dealers, who always get nervous when there's this much volatility and they reserve that much. But at 16, 17%, you're not seeing any loan losses, and you got unemployment that's actually still declining at an aggressive pace. And in particular, remember, part of the reason why their mix of loans is so skewed towards lower credit quality is because they actually have a lower set of people. I mean, I don't even think they went through this in the call, but if you think about what their loans are, it's like student loans. They're targeting absolutely college kids to try to give them that first set of credit ratings, I guess is how you talk about it. Because of that, that's probably the section of the economy that is most capable of getting a job right now. So all of that is really fantastic for the lower end of the card spectrum. Now, that said, we shall see. I'm not necessarily going to be screaming long or screaming short on these. If anything, what I did was I I did credit, I did Strangles. I didn't even do them. I feel bad in some ways. I feel very guilty to do this on a show. So don't do this unless you have excess capital, okay? But I did straight out Strangles on a couple of the consumer finance companies because the vol on some of these is over 100, and you can get them way wide at that point. And even if that's not the way these things trade, they do not move 30% after already getting clobbered 30%. I mean, at that point, you were trading below cash. So, and there's nothing in the US economy that would suggest that loan losses would just spike out like that. So with vol being over 100, those are the places where I absolutely was like, hey, I'm gonna do a strangle. But again, this is not, you don't do you don't do Strangles if you don't have capital. I'm just gonna say that, okay, for period. So just know that. But it really does tell you how strong the US consumer is. With Europe, we are also still seeing fairly strong consumers. With Asia, it's not, the consumer credit piece isn't as built out, and also you just don't have the same exposure. Like if you have a Visa, MasterCard, and you're using that instead of like Alipay, that's really bizarre, I think, for Asia. So regardless, if you're in Asia and you have a credit card, that is a very specific type of consumer. So we don't really care as much about that unless the wheels totally fall off. But the point is, that's what we're seeing. Now let's go back to GDP and the backdrop of things. You have to decide with supply tightness at all-time highs, whether or not you go ahead and make orders or you just kind of figure out what's going on. And let me be even more clear. With your supply being so tight and you having to deal with potentially, especially in the S&P 500, which I focus on, you have to figure out like what exactly is my exposure to Ukraine, Russia, and the secondary effects of that on demand. Okay, you don't have huge buffer to make a mistake. And so what we actually saw, that I think is why I'm not totally freaking out on a GDP down 1.4%, you actually saw inventories decline. You know, so I think that what we saw in the month was very prudent management thought process on saying, hey, you know what, we need to take half a beat and just make sure that this, and the other. And so from a timing perspective, the next month's GDP, I think, is going to be vital to really getting a picture. So just note that. Now, the other thing, now let's go into some of the folks that, so that's how I would interpret GDP for now. Tomorrow, we have more stuff coming out in the way of knowledge on economic picture. We've got PCE coming out. PCE is what the Fed prefers to use for inflation. CPI used to be what they used. And that just has to do with some of the adjustments that had to be made at the front part of this century. Like PCE didn't exist before 2008. Let me just say it like that. Or maybe if it did, it was like this kind of secondary thing. But PCE will come out, and then we'll have a little bit more data on how the Fed is looking at inflation. I mean, let's just be honest. Inflation's up. Like, what do we really need to see there? So we'll kind of see what's going on. And now let's talk about earnings reports. There are just so many, I can't even possibly keep track. I do want to review Google, Microsoft a bit because we've got Amazon tonight. And we also have, you know, I don't even think this is updated for all the names. So there's well over 120 that reported this week. You got Intel tonight. You got a few that are coming out tonight that are going to be kind of big bellwethers to move this market one more day around a bit. I also, so I'm going to talk about that. I'm going to talk about coal a bit. Shoot, I think I left off the Z here. And I'm going to talk a little bit about Caterpillar because I would say still overall across the earnings, you are seeing winners and losers. I know that there's a tendency for the powers that be in media to give very specific sound bites of everything is awesome or everything is bad or earnings are coming in better than expected. But the real thing you should add to that sentence, earnings are coming in better than expected, is earnings are coming better than expected by whom? By the company or by the street? And then was that better actually better, or were estimates really low and it was better, but this company is still getting squeezed like crazy because the supply is a problem? So the way that I do mine is legitimately no expectations, nothing. Was that a good quarter? In other words, did you increase revenue and were you able to get enough of it through to the bottom line where I don't start to be worried about other parts, not your income statement, but your financing arm or what have you. Alternatively, do I understand why you increased X, Y, and Z spending? That's how I think about better, but that is not how the street thinks about better. And when I use my judgment calls, it is a very mixed quarter. Like, even if you beat the street's estimates, I am concerned for you in the second half of this year. So we're going to talk about that after I get through some more of this earnings season, what the overarching look as right now. I think I've just listened to exactly 100 calls of, like, I think there's closer to 200 if I actually was able to get the counts correct. At this time of year, it's very difficult. Anyways, let's go through it. Peabody, I've been very bullish coal, and this thing traded all the way down to 20 this morning and has bounced up subsequently. And what I want to say here is that the reason these numbers came out crazy, I think, they took a loss or something, is because of the nature of what they have to do to get this stuff out of the ground and to the ports so it can ship overseas. That's really what it comes down to. Now, I want to just show you very clearly seaborne metallurgical coal, that goes into the making of steel. This was the price change that we're seeing. March of 2021, it was unprofitable. So tons sold, revenue per ton 87. That price in 1 year has more than doubled. And and then EBITDA, which I like to use from a profitability perspective, it was not profitable to be a coal producer last year. And then it's incredibly profitable now, because you think about revenue per ton. Okay. What does that mean? That means that this company had to ramp up production in the last year very aggressively during COVID, during a time when everybody else is trying to do the same thing, during what have you. Okay, now you should also know that Peabody is, even though it's a US-based coal producer, they also have some facilities in Australia as well. So there's a little bit of this going on. So when they talk about COVID and the continuous issues going on there, that is also another piece of what they're talking about. So with Peabody, some of these expenses are unique to Peabody. And additionally, so Powder River Basin, that went just fine. Everything was fantastic there, but they have to reinvest in order to get more out. Plus, there were some weather conditions that caused great difficulty in really being able to get that coal out of the ground. And then US Thermal, you can see how profitable that is right now. The price per ton they were getting was 38. Now it's not quite a double, but the point is that things are going incredibly well in coal, but probably the numbers will look funky for 1 or 2 more quarters. And also realize it's not easy to get staff for this business. So the other one that kind of has elements of that, but I think they'll do okay this quarter because metallurgical coal is getting the world's most amazing pricing up over 2 times. And also because really my only outstanding thing had been whether or not there were transport issues and staffing issues, but Warrior Coal, HCC, right? Sorry, I keep thinking of them from their old name, from what their old ticker still just reminds you. That one, if you're along it, if this quarter doesn't come out well, you want to hedge it for sure going into earnings if you can find cheap puts. But then after, I think this quarter, they should be fine because they did finally work through their labor disputes. Now, realize as well, the tonnage is coming out lower. So look at tons sold here. Okay, that is telling you, hey, we have to spend money to pull more coal out of the ground. Okay, that is really screaming as loudly as possible tight supply. And remember, especially with thermal coal, but also metallurgical coal, so the dynamic is a little bit different in thermal coal because you are still trying to fight against, or not fight, but you also compete with nat gas. But, we'll have nat gas, pretty much everybody reports next week. And given what the larger integrateds have already said, Hess, for example, has said this very clearly, but we'll have ExxonMobil tomorrow, and I think Chevron tomorrow as well. I think when it's all said and done, they're going to tell you supply's really, really tight, which means thermal coal should do just fine as well. Now, I also want to remind you, and this is why I was a little bit easier for me to be like Consol Energy. That's the coal bet that I would like, I feel a little more confident with. And that just has to do with where they're located. So both Arch, which has like some exposure to West Virginia, but I think they're even a little bit lower because this is like this is just the top 5 coal producing states. Okay. And there is like this, it's really the Appalachian Mountains is where they're taking the coal out from. And again, parts of the Appalachian do make the type of coal that would be thermal coal. That's really Consol's bread and butter. They do, yeah, I don't remember a lot of metallurgical going on in there, but I'm going to review and see because I'm not 100% sure. But Arch has a mix of thermal and metallurgical. They're a little farther south and where they're looking at it. And then Peabody's out west. So they reported that they had some difficulty getting rails to just load up the coal and move it. And that's really fascinating because I hear the same thing from the rails, to be fair. Did I forget? Oh, yeah. So here's Norfolk Southern. The other 2 rails did a little bit better, but Norfolk really had issues this quarter on just getting times up as far as how fast could they get the trains moving, how many cars could they get on the trains. Labor is still a big issue within the field of railway stuff. Rail carts. You know what? I'm still a little jet lagged, so it's hard sometimes to find the words. But this is the map, so you can kind of see where these things go. So apparently on parts of this map, difficulties arose in just trying to get the coal from point A to point B. To the West Coast, they reported a little bit better, and that's in line kind of with what I heard the rails tell me. So just realize that is becoming a real thing out there. Okay, so other things, Richard, I'm so glad you're on here. Archer Daniel Midland, just in follow-up, it was a brilliant quarter. The number one thing, and I think they'll do just fine. And the number one thing that we talked about before the quarter, and that we even had our wonderful professor come on from KSU talk about, and that just has to do with this dynamic right here. This is the dynamic that's gonna, and it's the second and third derivatives of this dynamic that is such a big deal, specifically for soy. So if you're a total nerd and you want to follow along and you're still trying to come up to speed on this, go back and look at the charts for soy, corn, wheat from last year. And you'll notice that soy was not nearly as positive as the other 2. And that really had to do with the dynamic that was going on in the soy markets. There were some really decent productions of soy. Now, this year is kind of a funky year because one of the outputs of soy is soybean oil. And you get corn oil and all this other stuff. So this whole Ukrainian thing was a problem, but also the sunflower seed production, of which they are a very large exporter. Like the lack of sunflower oil, which Asia uses like crazy, is a big problem. And it's a big problem because also palm oil, which is a huge application for both regular oil and oil distillates, as well as for, soap, everything else in the marketplace that you would need oil for. Palm oil production has been weak for a bit of time. And so in that case, all the other oils try to supplement wherever they can. So if it's for cooking, those, like this, that, and the other. But palm oil production is actually so weak, especially even for food consumption, that Indonesia is now no longer exporting it because they need to just try to manage inflation. And they are a huge producer of palm. I mean, if you've ever been to Indonesia, except for Bali, which is a big tourist spot, but you will drive past like palm oil plantation. The island of Sumatra is almost all, sadly, the government like rented it out to this big palm. So it's really a problem. And the only other country that is huge, actually there's many countries that are huge on this, but the other big in that region would be Malaysia. But in both cases, the point is that the anticipated thought is that soybean oil is going to compensate for this shortfall in sunflower and palm, both. Okay, so it's not soybean, I'm eating it, I'm exporting it to China, that sort of thing. It's actually this aspect of it. So we're watching for that. If that happens for ADM as they're hoping, then yeah, this thing should do fantastic. If it doesn't, the fact is everything else is going fantastic for Archer Daniel Midland. So I do think that as the volatility kind of subsides on it, you do want to be kind of long this for the year. I still have a lot of work to feel like where do I think it could go. So hopefully that's helpful though, but that's the dynamic that they're looking into and that they talked about. And it really it really connects with what we're seeing and what we're hearing from the nerds of agriculture, so to speak. So that's really exciting for folks that are into that name. Choppy for sure though. Now I'm going to talk about Google and Microsoft in the context of Amazon. Okay. First of all, Google, look, here's the thing. I mean, they did have Russian exposure and everybody is all about that, but I really want you to know that this other income line item, part of this is Russia, is here, right? It's 2020. And then this is what it was last year. So you do have this really bizarre comp that they're comping against that led to this because, you know, income from operations was actually up a lot on the quarter. And I think a lot of people missed that little fact, for lack of a better way to describe it. So I think that's why I know the technical folks will trade it however they want. You do have to be careful when trading Google because this is the type of name that people buy and hold for a very long time. And so to me, this dynamic is missing the point a little bit. If you're looking at if you're looking at earnings EPS instead of operating income, because given Russia, this is a very strong income from operations performance, right? Now, the other thing I want you to see, this is revenue, and I want you to see how strong the cloud business was for Google, even though everybody literally makes fun of the Google cloud business because relative to its competitors, it's not nearly as strong. Now, almost everyone is, except for Microsoft, is reinvesting in every single part of the business. That's why you end up with a loss for the cloud business. So there's that, but the demand for cloud is hella strong. Microsoft, I want to show you as well. They actually did an even more elaborate breakout. Usually they just break down the 3 segments, but they did this breakout this time, which I was like, whoa, I don't even know how to begin to think about this. But this stuff in red is really what I would say cloud and, you know, cloud related businesses. And you can see how strong that was year over year even. And that's despite continuous and massive growth throughout the period, and currency isn't doing anything to impact that at all. So given that particular dynamic, let's see, oh, that's ServiceNow. Given that particular dynamic, I'm trying to stay the hell out of Amazon today because it's really hard to tell if people will care about the consumer business in light of what's going on in cloud. I don't think that's the right way to think about Amazon, but I also don't want to lose money in case that is the way everybody else feels like thinking about Amazon. So I just as soon stay out of tomorrow's mess. I do have some very small reverse iron condors on it that have remained. I've taken profits on every other piece of it. So if that goes to zero on either side, I won't be crying in my cup, so to speak, because, you know. So what do I mean by that? I mean, I'm both long and short on a vol blowout if it moves aggressively in either direction. That's what I'm doing. And super small, like just so I can watch the screen, not so that I and buy coffee with it, something like that. You know, it's not that big of a deal, but I am a little bit worried and nervous about how Amazon will report or if it will do nothing. Like usually at least I get a sense for whether or not the thing's going to move or not. I have no clue. Okay. So there's that. On ServiceNow, this is very interesting. They really had a great earnings report. And the thing I wanted to highlight wasn't whether I think you should be long or short ServiceNow at this point or these levels. It's really that this R&D spend that everybody's doing is so high. And I just want you to see net income was actually down on the quarter relative to the previous quarter. So you had, you know, a decline in net income. And yes, you have also more expenses in general, but I want you to realize that with R&D spend, if the company, I think what's happening is if the company can clearly articulate how that money, and it's always been the case, but it's even more vital now. But if they're clearly describing a future where you make more money, I think the marketplace isn't being as aggressive as it might have historically been for failing to have numbers that are like showing top line and bottom line growth. This actually is an acceleration over and above what you made into R&D. The other company that had something like that is Facebook, and I didn't put that there. I think he did a great job on the call, even though the numbers look like hell, let's call it what it is. But I had said in the last quarter that he had spoken more than anyone else about the vision that he had for the metaverse. On this last call that he did, I think he did a phenomenal job talking about precisely what he anticipated would happen in the numbers themselves, using the stories, the transition from stories as the way to explain that you would get kind of like a 1 to 2 quarter dive, but then you would see acceleration in earnings taken all straight to the bottom line. And you are still with Facebook seeing top line growth, which is why with Facebook, even though it traded crazy and I definitely shorted it at different times within the quarter, I was never, I think David, you hate Facebook as far as that goes, but I was never really able to say that it was an outright short. And I think, he's such a young man when it all comes down to it. It's very impressive what his vision is for where he's going to take the company. Now, whether he's right and in 2 quarters, you will start to see the profitability flow through aggressively, or whether it's a little bit longer of a lead time and how that trades, we're just going to have to watch it to see what's up. That's kind of this R&D line, I think, is going to become, I always look at it, but usually I don't have other people asking me about it. That's what I'm saying. So that's kind of a thing that I wanted to highlight as well. And then other than that, let's see. I think that's where I'm going to pause today. DFS volatility. Caterpillar. Caterpillar had kind of a strange quarter. And what's happened with Caterpillar is that the Asia COVID shutdown, which is a thing for them, is not yet being compensated for by the infrastructure spending and things like that still are to come. And also at the same time, you've got this massive rising material costs, labor costs, et cetera. In a lot of ways, we've kind of quietly talked about this. Like, it's not something I've been really aggressive on, but it really bothered me last quarter that the infrastructure bill wasn't going to roll into any kind of revenue in a meaningful way until the 3rd or 4th quarter at best, but mostly the 4th quarter. So this is kind of more of the same on the pause period. As a result, I'm staying out of certain industrials. Now, that said, if your industrials happens to attach to the energy sector or autos, okay, everybody keeps trying to sell all the semiconductors. You couldn't possibly get more bearish on the semis right now with everybody saying that they're uninvestable, which I think is insane because they're posting some of the best numbers. Everybody's so sure that there's just way too much capacity coming online, even though literally every buyer of semis is like, I need more like crazy. That one, that's a different animal. Because, for example, the industrials that have exposure to autos are still seeing amazing sales. And that's everyone from basic materials companies like Corning, which sells glass, okay, to automobiles. The types of glass and my goodness, the types of glass and the quantities and everything as it relates to glass for automobiles is actually going really well. The semiconductors are reporting that they can't supply enough for the auto manufacturers right now, that sort of thing. So realize that is a very different dynamic than the industrials who literally kind of have to chill until a couple things resolve. And then with Boeing and others, it's like with the industrials, you're kind of in a holding pattern unless your end market is energy or autos. Those people are desperate. They need product right now. And then, so that's Caterpillar. And then on vol in general, whereas last week when vol kept trying to kiss 20 and I was like, guys, please, please, please buy vol. This is how I'd like you to buy vol. Please buy vol. Like, I think I literally had nothing else to talk about. Now that after it's like, given that all you've got left is Amazon, Intel, there's a few next week in energy. So then we'll talk about tomorrow and whether or not we need to hedge or what's going on there. But I'd be lifting some of my hedges or taking profits on if you were just taking an outright vol position, because the picture is the picture. And I think the volatility will be more isolated to single name. And so in that regard, I'd rather you be selling vol on names where you have greater clarity. And individually, if you're a vol trader watching this for some reason, then buying vol right now, because I think it's collapsing between today and maybe you get a little bit on Friday, but come Monday, there's, except for a couple of areas that still need to report, as far as the bigger guys go, vol's coming in. Anyway, with that, why don't I stop my share and take questions? Hey, Richard.
Hey, May, we bought Facebook 2 days ago.
Oh, good. That's
Fully-
awesome. That was a technical for you?
Yeah, fully hedged though.
Okay, yeah. Good, good, good. I'm glad. I should have joined you, but I was like, I had so much capital out already that I'm like, oh my God, which one is the better opportunity?
Yeah, Apple reports today.
Yeah,
That's
I don't know why I didn't mention it. I feel like Apple is a little bit less controversial than Amazon for me, but in fairness, Apple is pretty controversial right now too. But we shall see. I don't have anything great to say about Apple, so I won't waste your time on it as far as that.
I hope Amazon rallies like crazy so I can sell it.
We'll see. We'll see. Yeah. Because like, he's going to probably try to promote what he's doing on the cloud business, but like,
That's not the most of their business is retail.
yeah, you and I feel the same way. And it's just whether or not the market will listen. You know what I mean?
Okay, let me tell you about my credit iron
Yeah,
combo.
let's hear it.
It's called Teldoc, which got killed today.
Okay, yeah, I do know that. That's one of Kathy Wood's favorites, right? I think.
Right, poor girl. But
Yeah, I know.
we use the volatility to it causes the premiums to go
Spike
up,
up
right?
like crazy. Yeah.
So you sell that premium. So we sold the 29 put, bought the 27 put, bought the 33 call, sold the 31 call.
Oh wow. Okay.
All expiring tomorrow.
Yeah, you're gonna be fine. That's awesome. That's really great. I'll tell you.
It's a credit of 90 cents.
Yeah.
They paid to do that. That's cool.
Yeah. Some of the ones that actually I think you can do it on, oddly enough, I even feel comfortable doing it on United. So I have some, but I have them as Strangles. I'm like, screw it. This is actually so much premium that I don't even want to buy the other leg for what point. But you can collect on United, you can do like the forts. You have to kind of watch it. And vol right now is around 65, which is not like vol can definitely get higher for United. But you could do, you could try to find your premium at 45 and 57, 58, but you kind of have to watch it. And therein you can collect $1 if you go 3 weeks out, 2 weeks out. But the airlines are always a little scary.
Yeah, the implied vol on TDOC is 108.
Yeah, it's high. You just have to go wide enough. And I think on earnings, if there's not, now the only thing is I've actually done that before on something like Tesla and the thing moved aggressively, then I kept moving aggressively. So you do have to be a little careful on your legs there, but you've only got one data expiration, so you should be okay. Most you're gonna have to do is roll it back. But yeah. Volatility is just too high. The biggest thing was whether or not we were going to have massive issues on the consumer side. The consumer is still very strong. And actually now there's greater clarity on why the consumer is strong and that's going to continue because we continue to see unemployment decline despite all this stuff. And all the companies are really clear that their biggest issue is their short labor. Whereas I think a lot of people were unsure, at least I was, whether or not the various things that are happening around the globe would change that. And then, or make the companies at least pause on hiring. You know what I mean? The only thing they're pausing on, the only thing they apparently paused on in the last month was buying new inventory. So all of this where people are like, oh, people are just stocking inventory like crazy. Who are you talking about is what I'd like to know. Cause I didn't see it,
Okay, could you explain for our listeners how I could lose on that trade?
Oh, okay. So if it moves aggressively, we'll use one of the ones that I think everybody that is traded has a little bit more experience with. I'm making a big assumption here, but if you just look at the chart on Tesla, right? Tesla is very dangerous to do iron condors on earnings. Okay. It might not be for other things, but on earnings, you got to watch yourself because Tesla sometimes can move 10% and then it'll move another 10% the very next day. And vol's high on Tesla, don't get me wrong, but if it moves another 10% the next day and you weren't wide enough, you're going to eat all of that premium. So let's say you did a 5-point spread and on that like 5 points on the top, 5 points on the bottom. And let's say you actually collected $2 on that, right? So you collected $2, your potential loss is $300, like 200 is $3, right? So if it moves aggressively in one direction, and then it moves aggressively again in that direction, then you can actually lose that $300. You know what I'm saying? Because it'll move right past the outer part of your strike.
But the risk on this is I've got a 2-point spread that I've shorted, right? So the most I could lose is 200. Less what I've taken in, which is 90. So most I could lose is 110, correct?
Yeah. So it just depends the size you did, you know what I mean? And then if you know the stock, which I think you do, because you tend to know pretty much all the stocks you trade pretty well. And you've probably looked at the chart, or even if you haven't had a chance to look all the way back, look at it. It's just like, does it tend to move and then move again? Does it do the double move? Like stock, you know, so this morning with PayPal, I did have some Strangles on, which moved very similarly. I just didn't bother to do the other part of the iron condor, but I had Strangles on at like ridiculous, because the vol on PayPal got to 120 yesterday. So I had them at like 60, 70 and 60. No, I think I had them at 60 and 50 on the bottom, and I had them at like 120, 130, something like that. And I think I collected over $2 for that. You know what I'm saying? So like $2 on a 5-point spread is fantastic, because the downside is, again, that 3 points, but it was so freaking wide. PayPal doesn't move like that. PayPal moves like 10 points, not 30%. And it's already down and gotten cratered so much. I know the hell it's not going to 120, because that's where it was before it got cratered this last time. Plus, you know, a whole number of things, let's call it, that I just feel about. And then I mean, I did actually a world's funky structure, so I won't even talk about all the things I did, but almost all of them, since it really kind of did, I think, better than what people were into. It's so funny, because now the street is so negative on PayPal. Anyways, we'll come back to that. But yeah, right now, especially if you, you know, there's a few people that listen to the replays on this, or alternatively, just watch the Discord when I type things in there. And they really know their companies well, as far as how they trade, you know. And if you really know how a company trades, and you're seeing volatility that makes no sense, and you can confirm that there's not much that can be said on the quarter, then yeah, selling overpriced vol is one of the best trades around. And right now, the reason I think that you have this massive overpricing in vol is because the macro is insane right now. And so then on top of that is your single company. So some people, what they do is they think of volatility and like, this is the volatility of just the company. And then this is the volatility that I've described to geopolitics or macro related stuff that could potentially slap my company in the face. Let's call it like that. Now, geopolitics for a company that is US based, very different, and has no exposure to international, should be very different than geopolitics if it's a big international company. Should also be very different if it's in very particular industries that happen to benefit from conflict in Europe and also COVID shutdown, et cetera. And right now, I think it's been a really long time in the markets where folks have had to differentiate between those buckets of volatility coming from geopolitics and the buckets of volatility that are coming from whatever the company is going to say that's crazy on the call. And yeah, so as a result, if you do just a little bit of work on that, you could sell vol into this marketplace right now and be really, really happy with yourself at the end of every day. All right, I'll pause. That was a lot.
My take on Facebook is I mean, yeah, they're going to metaverse, but I don't think they're going to throw away their current business.
No, it's an augment. They're trying to transition their subscribers.
Right.
Yeah.
So, I mean, they're not going to say, hey, we're done with Facebook, we're all meta now. So I think it's business as usual with Facebook. And like they created this Reels project that I don't know if you've tried it or not, but to compete with TikTok. Other TikTok, to compete with TikTok. So I don't know. I just started thinking, I'm like, they've done so well, to just throw it away would be absolutely asinine, which I don't think they did.
Okay, so I don't think of it as throwing it away. I think about like it. So the thing that I'm
saying they did not. I mean, All they're doing, they're just saying, okay, 10 years from now, we're going to be more meta.
Yes. And also, so you really got to give Mark, you know, I think even I admired him before as a just being really brilliant, right? Like for better for worse, he ain't perfect, but he's a lot younger than me. And so I remember what a knucklehead I was, you know, so I'm not going to be like so judgy, you know? So like, but as far as vision goes, and this is really the difference between why you'll hear me say very negative things about some companies. And like with Facebook, I've like really hedged how I've talked about their earnings decline, let's call it, right? And this is true whether I'm talking about PayPal or Netflix. I have no problem shorting Netflix or PayPal at a price. Here, down here where PayPal is, I think it's actually probably starting to trade where it should. So I'm a little bit less aggressive about my passion there. Because you recall way back, I was saying around 80 is where I would stop shorting it and look at where it's sitting now. But anyway, with respect to both PayPal and also Netflix, my issue isn't that I'm watching the numbers like a hawk. My issue is that their markets have changed aggressively, and the strategy that they're talking about, to me, doesn't get them to that next phase. For Facebook, what he's saying makes a lot of sense. You know, he's like, look, I had to make some gigantic changes when Instagram came out. Number one, I bought Instagram. Number two, once we got to Instagram, we had to like transform that, and WhatsApp, by the way. We had to transform our core business to integrate more fully so I could see why people were doing all of this platform, because at the end of the day, this is what we want and we see as a vision of the future. So all of these pieces have to fit together. There's also this piece called Horizon that he talked about, right now not profitable, but it's going to link all of this together in this beautiful way, in this vision of an experience that he believes is what people are trying to do socially. That I can give him a lot of time to figure that out and not be a jerk as a person, you know, as a person that's an investor. Okay, Netflix looks like they're throwing spaghetti on the wall. Okay, he's like, look, you know, first of all, I just want him to mouth the words. Yeah, I lost market share. If he would mouth those words for me, which he kind of intuitively said a bit, and then after that, I would like him to say, this is what we're going to do about it that we are pretty sure will take us into the new way that people are viewing stuff, right? Short of that, it's really hard to think that in the next quarter, that company is going to continue to do anything but lose subscribers. Now, maybe they're going to get like a blip up if they're able to like become the subscription police. Okay, so I'll give them that. But if you become the subscription police, all you're really going to do is drive people to make very hard decisions about who they want to stay with and who has to go in the amount of in what it is they want to watch. So the most that they're doing right now to change things is modifying how they price existing customers and what they're calling the other customers that they don't know about yet. Now, a lot of people, they've mouthed to investors about gaming for a while, right? They're going to buy something, but what they haven't mouthed to investors yet is the way in which they'll implement it and what they've already done that they see as successful growth. If they could mouth that to me, I'd be cool. The other thing too is they've tried a bunch of stuff, and I see the most lackluster attempts at stuff that isn't quite doing it. So number one, they've tried to do this thing called interactive. If you're a nerd and you like the game Boulder Dash, that's what that is. It's like choose your own adventure. My issue with that is that you can't even find it easily when you search. You have to actually search the term interactive in Netflix to ever even find one, unless you like happen to be a Boss Baby fan like me. So they clearly spent money on it from 2018 to now. No one uses it. And quite frankly, it's horrible. And the reason it's horrible is whatever skill set they have in storytelling that exists in their core business, they are not extending in a meaningful way to that business. Those stories are horrendous. I don't even want to click. Like the choices that you're asking to make are stupid. They're not interesting. And the gaming portion of it, that to me would have been the gateway into gaming. But it's clear that whoever's driving that doesn't care, in my opinion. Or if they do care, they're not getting enough capital to care or capital to be able to execute whatever it is. So that is unfortunate. The other thing that they could do is to move full on into 3D world. I haven't seen shit as far as that goes. I'm just gonna call it what it is. I'm not sure. Sometimes I gotta watch my language. Sorry, but I haven't seen anything, even though they have the most subscribers. If they would show me that, I'd be like, ooh, this is exciting. I can watch this for a couple quarters. Until you show me that, I'm like really not excited, because the reason you missed it was because everybody else like spent COVID coming up like crazy. So that's my beef with Netflix. Yeah. And then my beef with PayPal is that you just lost your CFO, and I get it. I mean, working at PayPal versus working at Walmart, maybe, right? You got a new lady in there, but what you're talking to me about is doubling down on the core business. Friend, do you understand what is changing in the way of fintech? You doubling down on the core business is not going to fix the fact that your operating margins keep compressing. That's like not going to fix it. So that's my beef with him. I mean, potentially what he's saying is that I want to make the core business more profitable first and then do a series of really cool innovations next. I kind of need to hear that, because what he said was, I'm not buying any companies that move us into other markets right now. I'm going to fix the core business. So he's got at least another quarter, but does he deserve to trade below 80? I don't have as strong a view there. That was a lot. Sorry, guys.
No problem. Richard, you there?
I am here. Yes, sorry. I had to find the unmute button. Yes. Hey, so, David, it's interesting because I looked at Netflix this morning, and I was in this doggone PayPal trade, and I missed my upside on Netflix today, which was a nice trade to the upside. But yeah, it's been a struggle with the volatility today. I was trading to the downside, and of course I got out of PayPal to the downside. It was consolidating forever. Yeah, and as soon as I did, it took off to the upside. I'm like, okay. I didn't chase it. But now I'm in an AMD trade to the downside. It ran up earlier today, and I'm looking at it now. I'm sort of giving back some of what it gained. So this challenge I'm doing, I'm trading with a small account starting at $500, and I'm going to turn that into whatever I can over the next 4 months, with the goal of making 10% per day on average in the account.
Cool.
And if the ideal amount at the end of 4 months would be $500,000, but we know that's really tough.
Yeah.
That would be really tough.
Volatility. I think this market, there's so much volatility. You have to be very nimble as a day trader, but I know you are. So I think you got a shot. I see volatility all the way through the summer. So if there's volatility, it's going to be fun to day trade.
Yeah, it is fun. It just, you can't you can't turn away from the screen.
Yeah. Do you have any questions?
How was your trip?
My trip is good. It's so busy. Like, the airports are full. Domestic flights are crazy full. It's really, it always is really fascinating to see the actual economy when you're like moving around and the such. So far, it's good though. Day one. Omaha's really nice. People are really nice here. I've had nothing but pleasantness so far.
Yeah, last time I was in Omaha, I was drinking a bunch of shots, and we were doing donuts in the snow after the bar closed. So that was a long time ago. That's
funny. All right. Any other questions, or should I let everybody get back to markets?
Thank you, May.
All right. Bye, guys.